Remember how that works. Interest rates, market value of the bonds. This is when it's issued. So when interest rates go up like we're seeing it now, the market value of the bond goes down. As long as there's not a run on the banks, that truth can be hidden. But when there is a run on the banks, then the banks are forced to sell these underwater debt instruments, and it becomes more clear because that pushes interest rates up even more and market value of the debt down even more. And it's more than just bonds, right? A mortgage is a debt instrument, a car loan, a student loan. Any kind of debt is really going to be majorly impacted by these interest rates because now they have to roll it over in a higher interest rate environment. And you might recall the interest on the debt that the US is paying and how that's gone up exponential. So that's what we're looking at here because the 40-year bond, so again, just as a reminder, right? If this is when the bond is issued and this is when it matures, look at the further out the maturity, the greater the market price swings. So the closer it is to when issued, the short-term bills that our government's issuing a ton of, especially with stable coins, right? That will have less of a movement when interest rates move. But these 30, 20, 30, 40-year bonds, that's where you get the greatest movement. And so a lot of governments have been going shorter and shorter and shorter and shorter term. The problem is then they have to roll that debt over and pay even higher interest rates on it.